Of the historic deflationary episodes he reviewed, currency hoarding was a common feature as individuals focused on capital preservation. Think in present days about the disappearance of Australian $100 notes into deposit boxes and safes. But they always prefer gold to paper money. Monday, July 29th, 2024, Maneco 64, home of alternative economics and contrarian views. So we're going to look at the Great Depression today, and specifically how gold did during the Great Depression. There's a lot of misconception, in my opinion, that gold would not perform well during a deflationary collapse. So I'm going to refer to an article that I found recently, and it's from 4 years ago, just under 4 years ago. And it's a great article. It gives you information about what really happened, not just in the United States, but in the major Western countries as far as gold was concerned. Before I do, though, just look quickly at some stories that will be important this week in the markets, for the markets, not just for the US, but for the UK as well. This week we've got the Bank of England. They meet on the 1st of August, which is Thursday. They are expected to cut from 5.25% to 5%. They haven't cut yet, even though countries like Switzerland, Canada, even the ECB has been cutting rates. But it's not like a done deal for the Bank of England, mainly because there's worries about the service sector prices, and those are still rising at 5.7%. And why is that important? Well, because the service sector is over 80% of the economy, and that's why the 2% CPI number that we've seen in the last 2 months in terms of inflation doesn't seem right. I would argue that prices are rising a lot faster even than 5.7%. So that's why there's a little bit of division within the Bank of England. For the Fed, on Wednesday, they're expected to keep rates unchanged. So Fed expected to keep interest rates steady, but to tee it up, to tee up September cut, that's from the FT. They could do that. So the Fed announcement is on Wednesday at, I think, 2 p.m. Eastern time. They also have the press conference, and I think they'll come out with some of their projections as well, economic projections, their dot plot chart that will be important for the markets. So before we go into the Great Depression and how gold did, and I think you're going to find it really interesting, I just wanted to give a shout out to Dirty Men Safe, one of my affiliates. So what is Dirty Men Safe? Well, you can bury your treasures and not your fears with it. Begin your security journey with exclusive perks. So what are they providing right now if you were to buy a Dirty Men Safe? And there's a link to it below in the description where you get 10% off using my link. Well, you would get right now, if you sign up and could receive one of 2 special gifts with your order. You could get a 10 free coin holders, or even a crypto seed phrase plate and marking pen, plus an extra 10% off, of course, if you use my affiliate link. So it's hidden protection, instant access, and with the chaotic and crazy and divided world that we're in, where the rule of law is getting more and more shaky, I think it's a good idea to protect some of your assets with the Dirty Men Safe. So It's been a debate between deflation and hyperinflation, or even deflation and high inflation. It doesn't have to be hyperinflation. And I even remember having it with some of my colleagues at work, colleagues that I actually convinced to and turned into gold bugs, sound money guys. There are not many of those. I could count it on one hand in the company that had over 1,000 brokers. So it wasn't something that was very popular, but it's becoming more popular. But I always remember one of my really good friends that was into gold saying that he thought we'd have a deflationary collapse first, and then gold would go through the roof. And I tended to have the different opinion, because in the fiat currency world, where politicians, central banks can access funny money or funny currency out of thin air, it's going to be very hard to deflate things. It's not popular. You don't win elections with deflation and joblessness. People would rather have a little bit of inflation and their jobs. Back in the late 1920s, early 1930s, the welfare state hadn't really been set up yet. There weren't all the mechanisms of a welfare state, and the central banks weren't as profligate as they're now, nor were governments. So that's why I always thought there would be high inflation that could end up with a currency collapse or hyperinflation. But I have to admit, nothing is certain in life, and we have to look at the risks and what else could happen. So that's why I found this article here very interesting. And it's from November 27th, 2020. The website is smallcaps.com.au. It looks like it's an Australian website. It says what history teaches about gold in economic crises. So let's go through it, and hopefully it will give you another perspective. I'm not saying this is going to happen, but it could happen. So deflation as well as inflation can cause conditions in which gold is an attractive acquisition. And by deflation and inflation, I think this author means the deflation of the currency supply, liquidation, an economy going into a deep recession or depression, and inflation is the other way around. It's what we've had. We've had for the last few years. What we can learn from history is becoming important now that we are in unprecedented times of zero interest rates. And with the Federal Reserve signaling this could ensue until 2024. Well, that wasn't the case, but it doesn't really matter. What we're going to look at here is what happened back in the day. The inflation case is clear. Gold, rather than paper money, maintains its value. But anyway, let's daydream for just a few moments about a world where gold is the one trusted store of wealth, as it was during the Great Depression. And I just wanted to clarify, I'm not saying you should be buying miners here, because he talks about the miners. That's up to you. I have a holding of miners, but it's a small percentage of my precious metals portfolio, if you want to call it that. But it's interesting. Huge dividends from gold miners during the Great Depression. So what companies would one think about nowadays that could do as well as home stake mining, which he's going to talk about? Well, I would say Newmont and Barrick. maybe Franco-Nevada. I'm not sure how big a dividend they pay. But anyway, gold's role in deflation was amply demonstrated by home-stake mining in the US, which saw its shares rise each year between 1929 and 1935, and so too its dividends to shareholders. During the 6 years of the Great Depression, home-stake mining paid out $128 per share in dividends. If you bought home-stake mining shares from your Wall Street broker in October 1929, they cost $80. But by 1935, home-stake stock was worth, wait for it, $495 per share. But there is also another big story of the time that should resonate and bring comfort to the gold sector. The formation in March of 1933 of what would become one of the giants of Australian mining, Western Mining Corporation. Remember, this was possibly the worst year of the slump. The Dow Jones, by the end of 1932, having lost 82% of its worth since the 1929 crash. The depression and the increased value of gold had an extraordinary effect on the industry in Australia. According to the 1935 Australian Yearbook, the value of the gold yield in the country in 1929 was the lowest recorded since the discovery of the metal in 1851. There was a slight increase in production in 1930 as gold prospecting started to pick up and operators looked to start working over old mining areas. But then the price of gold paid to miners started to get a move on, rise. London-based Wailuna Gold Corp, mining in Australia in 1934, paid a dividend equivalent to 22.5% of the face value of its £1 shares. And this is an interesting part here about the supply and demand of gold and the price, because gold is truly unique. It doesn't seem to follow economic law, and I think it's because it's money. And it says here, gold continues rising despite increased production. What you have to remember is that in parallel with its substantial increase in the gold price, prices of almost everything else, labor, fuel, food, etc., were actually falling. That is deflation. Well, I would say that is the consequence of deflation. But anyway, let's keep going. Which must have significantly improved margins for the mining companies. But what is significant is that the gold price kept rising during the slump in the face of not only increasing mine production, but the sudden surge in scrap supplies. Gold recycled from jewelry and other items soared as owners needed money. In the year to September 1932, British India exported the equivalent of 11.5 million ounces salvaged from fabricated items. Germany was another big source of gold from scrap. In other words, the world in the 1930s just could not get enough gold. Behavior of gold under inflation. Long before people began to think about and worry about deflation as the 2008 global financial crisis hit. In 1996, a hedge fund consultant named Sam Hewitt wrote a paper, The Behavior of Gold Under Inflation, showing that in every instance of deflation since President Andrew Jackson, Americans had preferred gold to paper money. He studied the deflationary periods following the panics of 1837, 1857, 1869, 1873, 1893, 1920, 1929, and 1931. Of the historic deflationary episodes he reviewed, currency hoarding was a common feature as individuals focused on capital preservation. Think in present days about the disappearance of Australian $100 notes into deposit boxes and safes. But they always preferred gold to paper money because gold did not represent the liability of any institution and therefore is unique among currency alternatives. In 1932, when severe deflation was kicking in, people not only hoarded gold, they wanted to dig more out of the ground. Never before has the world been so thoroughly grubbed for gold, reported Time magazine on 12th of December 1932. Old-time prospectors swarmed to abandoned gold fields, and minor gold rushes were reported to be happening in Australia, South Africa, Chile, the Philippines, and Venezuela. In the early 1930s, the South Australian government provided transport to get prospectors to the Tarcoola area. In February 1933, the Wall Street Journal reported the world mine production in 1932 had reached a new record of 23.9 million ounces, up 7.8% on 1931 output, and valued at $494.2 million. Not only that, India had unlocked much of its gold reserves to meet global demand for the metal. It was estimated that British India between 1873 and 1931 had accumulated gold worth as much as 600 million pounds, about 40 billion pounds now in 2020. That's how much it was worth. By the end of 1933, the Los Angeles Times was reporting that California had embarked upon a new era of gold mining, and there were more than 800 mines operating in the state with around 12,000 men prospecting in the mountainous areas. This was in spite of the U.S. government banning private ownership of the metal. President Roosevelt, of course, Executive Order 6102, forced Americans to hand over their gold to the government and made the possession of monetary gold by any individual, partnership, association, or corporation a criminal offense. In 1932, not only had the world produced more gold than ever before, the central bank holdings rose to their highest level ever. Sounds familiar? By the 1st of January 1933, the US and France between them held 61.5% of the world's gold stocks. That's the official gold stocks. That's not total gold stocks. And European central banks were keen to retrieve their bullion stored with those two countries. Repatriation is happening today. In the first quarter of 1932, Washington repatriated 23.3 of gold under its care. Austria passed an emergency law forbidding gold being taken out of the country. The government even prohibited dental supply houses buying the metal. Dentists were being used by investors and speculators as a front to buy the metal legally. Italy launched a battle for gold to encourage people to turn over their metal in return for paper money. Well, good luck. I'm sure that wasn't very successful. Author says, I will leave you to detect any parallels or portents for today's situation. So we did get inflation since he wrote that article. Gold has kept going up. But there are some people, and they might have a point, that if the central banks, especially the Fed and the Bank of England, are too late in cutting rates, too late in doing more QE, we could see a major financial crisis in the banking system that will make it too late for the Fed to come out, cut rates, and do QE. It might not work this time, and we could end up having a major deflationary collapse, and it wouldn't be because they didn't try. It might be just because it can't keep going on forever, or they might be able to, or they will do QE, money printing and fiscal policy, but that would just destroy the value of the fiat currency. So either way, in both situations, major deflationary collapse or a major inflation approaching even hyperinflation, you want to have your gold and your silver as well. So there you go. I hope you enjoyed that article. I thought it was quite interesting, the historical perspective of what happened in the 30s. I always thought that there wasn't enough gold around, and that's why Roosevelt had to ban it. But it looked like gold was being produced quite abundantly, but it wasn't enough because people were fearful. That's the thing about gold. That's why the increased supply of gold didn't affect the price back then. And eventually, you kind of wonder when Roosevelt reset the price in January of 1934, if he was just following what was going on really in the free market around the world. He raised the price of gold from $20.67 to $35 overnight. That's per troy ounce. So let's quickly look at where the markets are this morning. It's 8:20 a.m. London time. We've got spot gold at $23.92, is up about $5. The high's been $24.03 and the low's been $23.84. Silver is trading at $28. It's up about 7 cents. And this is the spot price. The high's been $28.21 and the low $27.83. Dow futures up 100 points. NASDAQ is up 94, NASDAQ 100. S&P is up 16 points. So we up slightly in the stock market. The currencies are a little weaker against the dollar. The pound is down about 0.2%, 128.45. And the euro is down slightly at 108.50. The dollar is down 0.2 versus the yen, 153.46. WTI crude, that's unchanged, 76.90. Brent crude is up slightly at 80.35. And we'll finish off with the U.S. Treasury yield curve. There's talk of disinversion, of course. The 2s, 10s are still inverted by about 19 basis points. So we've got the 10-year down 3 basis points at 4.17%, and the 2-year down about 3 basis points at 4.36. So with that, I'm going to wish you all a very good day and a very good start to the week. Take care. Bye.